Welcome back to your daily briefing. It is Monday, March 2, 2026. And if you are a learner tuning in to track the markets this morning, you might be feeling a pretty distinct sense of cognitive dissonance right now.
Yeah, that's definitely the phrase for it today. It's a classic case of the market completely ignoring the headline risk, or at least interpreting it way differently than anyone on the street would expect.
Right. And that is putting it mildly. Let's get the big number out of the way right at the top. Despite a weekend that felt like things were spiraling out of control globally, and despite some really serious volatility overnight, the Bitcoin price has risen nearly 5% since the U.S. market opened this morning.
And it's a massive bounce. We're seeing a resilience that honestly defies the traditional risk-off logic that we usually see during these global crises.
And that is exactly our mission for this deep dive. We have a stack of intelligence here covering the last 24 hours, and it covers everything: the price action, the kinetic situation in the Middle East, institutional money flows. Our goal is to figure out why the market is rallying while missiles are flying. Is this the flight to safety narrative finally taking hold, or is it a trap?
To answer that, we really have to peel back the layers. We need to look at the liquidity mechanics first, then the energy markets, and then this really fascinating split between how algorithms are trading this war versus how actual human beings are trading it.
Well, let's start with the baseline numbers, because before we got this 5% pop this morning, the weekend wasn't exactly a walk in the park. Can you break down the setup for us?
Sure, it was a very choppy weekend.
Yeah.
If we isolate the 24-hour window ending at 7 o'clock CST this morning, you can see the tension clearly. Bitcoin entered that window trading around $66,400. By 7 o'clock, right before the U.S. Open, it had drifted down to near $65,900.
So overnight, the bears were definitely in control.
They were pressing, yes. We saw a depreciation of about 0.5% in that specific window. But the context here is vital. Yesterday, March 1st, we actually hit an intraday high of $67,200.
Right, that was the market trying to stabilize after the initial shock of the news regarding the Iranian supreme leader.
Exactly. They digested it and tried to move on. But then the situation on the ground changed. The kinetic escalations, which we will definitely get into, forced the price down to a trough of $65,100. And this is where the technicals get incredibly interesting for anyone watching the charts. There was a specific dip at $17 CST on Sunday where the price hit $65,230.
You've circled that specific number of the notes. Why is $65,230 the line in the sand?
Because that was the ultimate test. That was the moment where the bears threw absolutely everything they had at the market, fueled by genuine geopolitical panic, and the market absorbed it. That $65,000 level is acting as a massive structural floor. The fact that we didn't break below it suggests there is a wall of passive buying demand just sitting right there.
So even with the terrible news cycle, there were enough buyers stepping in to essentially say, no, we are not going lower than this.
Precisely. And this leads us to the supply side of the equation. We keep talking about supply shock on this show, but I don't think people realize how acute it has actually become. Spot exchange reserves have plummeted to 2.6 million BTC.
For the listener who maybe doesn't track exchange reserves every single day, put that 2.6 million number into historical context.
It's the lowest level since 2018.
Wow.
Yeah, think about that.
Yeah.
We are in 2026. The entire industry has grown exponentially. Adoption is up. Wall Street is here. Yet the available inventory sitting on the shelves is lower than it was 8 years ago.
That is a staggering disconnect.
And here's the kicker. We just saw $1 billion in fresh capital flow into the ecosystem, and that ends a 5-week outflow streak. So you have $1 billion of fresh demand chasing a supply level that hasn't been this tight in almost a decade.
So that explains the floor. The smart money isn't panic selling into the war news. They're actually treating this dip as an accumulation zone, taking coins off the exchanges and locking them in cold storage.
Correct. They are removing the asset from circulation. But we really cannot ignore the reason for the volatility in the first place. We have to address the why behind that dip to $65,100. The intelligence uses the term kinetic escalations.
Yeah, let's unpack the geopolitical side, because while the charts are green this morning, the news from the Middle East escalated significantly in the early hours of March 2.
It did. The conflict transitioned from posturing to active multi-front engagement. According to the sources, Hezbollah launched a significant barrage of precision rockets and drones targeting the Mishmar al-Carmel missile defense site near Haifa.
And this isn't just the usual border skirmish?
This is a major strategic shift. This is the first direct, large-scale engagement from them since the 2024 ceasefire. And explicitly, they framed it as retaliation for the killing of Ayatollah Khamenei.
And I assume the response to that was immediate.
It was. Israel responded with heavy airstrikes on Beirut's southern suburbs. The reports we are seeing confirm at least 31 fatalities and 149 injuries.
It's a heavy situation. And we should remind you that we are just analyzing how the market reacts to these events. We aren't taking any political stance on the conflict itself. But usually when you see this kind of global instability, that Bitcoin is a safe haven narrative gets thrown around. People think, war starts, gold and Bitcoin go up. But that didn't happen immediately last night. Bitcoin initially dropped. Why?
This is a nuance that confuses a lot of people. In the long term, yes, Bitcoin can act as a store of value. But in the immediate short term, and I'm talking minutes and hours after a flashpoint event, Bitcoin behaves as a high beta risk asset.
High beta basically meaning it acts like a tech stock on steroids.
Exactly. When a war escalates, uncertainty spikes. The institutional algorithms, the trading bots running Wall Street, switch to a risk-off mode. They need to secure liquidity immediately. Now, if it's Sunday night, you can't sell your Apple stock. You can't sell your real estate. You can't even sell your treasury bonds.
But you can sell Bitcoin.
You can sell Bitcoin 24/7. It is the only asset that is fully liquid at 3 in the morning on a Sunday. So when these funds need to raise cash to cover potential margin calls in their other portfolios, they use Bitcoin as their ATM.
So the initial crash isn't because they lost faith in the asset. It's because Bitcoin was literally the only thing they could sell.
Exactly. It's a liquidity tax. Bitcoin gets punished in those moments simply for being efficient.
That makes a lot of sense for the financial plumbing. But war also hits the physical world, and in the Middle East, that always means oil. The dossier mentions a strike on a major refinery. How bad was it?
This is the second layer of macro pressure. There was a direct Iranian drone strike on Saudi Arabia's Ras Tanura refinery.
Ras Tanura, that's the big one, isn't it?
The largest in the Middle East. It has a capacity of 550,000 barrels per day. The strike forced a precautionary shutdown of the entire facility.
That is a massive amount of energy suddenly taken offline.
And the market reacted instantly. Brent crude surged approximately 10%, pushing right toward that $80 threshold. Now, OPEC Plus, specifically the Voluntary Aid Consortium, they did try to calm things down. They agreed to an emergency production increase of 206,000 barrels per day starting in April.
But wait, 206,000 is a lot less than the 550,000 that just went offline.
It is. And honestly, the dossier describes this OPEC move as largely symbolic.
Why symbolic? Just because of the math.
Because of the logistics. The Strait of Hormuz is effectively under a blockade right now. 20% of the world's oil transit passes through that exact choke point, and is currently paralyzed. It literally doesn't matter if the Saudis pump more oil if they can't get the tankers out of the Gulf safely.
Okay, so let's connect this back to your portfolio. We have oil prices spiking. That usually means gas prices go up, shipping costs go up.
And that spells inflation. That's the economic link right there. If energy prices spike, we get a structural inflationary shock. And if inflation rises, what does the Federal Reserve do?
They can't cut interest rates.
They certainly can't. They might even have to keep them restrictive entirely through 2026. And historically, high interest rates are kryptonite for high-growth assets like crypto. If you can get a guaranteed 5% or 6% yield in a bond, institutional capital is less likely to take a risk on Bitcoin.
So let's recap the bear case here, because it's strong. We have kinetic war causing panic selling from algorithms. We have an oil shock threatening global inflation. We have a Fed that is likely to stay hawkish. By all accounts, the market should be crashing.
On paper, yes, it looks like a perfect storm of downward pressure.
And yet, here we are, up 5%.
Up 5%.
Which brings me to the counter-narrative. We talked about the Wall Street bots selling, but I want to talk about the humans, because the intelligence highlights a really fascinating situation developing in Pakistan that completely contradicts the risk asset theory.
This is where the story gets really compelling today. We are seeing a real-time divergence in behavior based entirely on geography.
What exactly is happening on the ground in Pakistan?
Well, following the attack on the Karachi U.S. consulate on March 4th, where 9 demonstrators were killed and 32 were injured, the civil unrest has just spiraled. It's spreading to Gilgit-Baltistan, UN facilities are being burned, the government is struggling to maintain basic order.
And usually when a government gets desperate in those situations, they go for the banks.
Correct. The intelligence points to an imminent threat of state-enforced capital controls. People there are terrified of a banking holiday where the banks just don't open their doors and you suddenly can't access your own money.
So if you are a citizen in Karachi right now, What do? You can't trust the local currency. You clearly can't trust the banking infrastructure.
You turn to the parallel system. The data shows a massive spike in localized demand for Bitcoin and USDT, Tether, specifically on peer-to-peer networks within Pakistan. Capital flight is happening in real time.
So while the trading algorithm in New York is aggressively selling Bitcoin because it thinks the world is too dangerous, the actual person in Karachi is buying Bitcoin because the world is too dangerous?
Precisely. To the Western investor safely sitting behind a desk, Bitcoin is a speculative bet. But to the person in a collapsing jurisdiction, it is a lifeboat. It is the only bearer asset they can own that the state cannot seize or freeze with a phone call.
That is such a powerful dichotomy. The core utility of the network is being proven in real time, even if the price chart looks messy in the short term.
The utility is the floor. When things break on a sovereign level, regular people don't run to stocks. They run to censorship-resistant assets.
Speaking of running to assets, let's pivot to the corporate side. Because there is one entity that seems to be treating Bitcoin as a lifeboat, but on a multi-billion-dollar scale. Strategy Inc. and Michael Saylor.
They are operating on a completely different timeline than the rest of the market. While everyone else was doom-scrolling the geopolitical news over the weekend, they were buying.
What is the latest update from them in the dossier?
They filed an 8K with the SEC this morning, March 2. They officially confirmed the purchase of an additional 3,015 BTC.
And this wasn't an old purchase they just delayed announcing.
No, it was executed between February 23 and March 1, so they were buying right through the volatility. They spent approximately $204.1 million at an average price of $67,700.
Wait, $67,700? That is actually higher than the current spot price. They aren't even trying to snipe the bottom, they are just market buying.
They are completely price agnostic. They're just accumulating volume. This purchase brings their total corporate holdings to 720,737 BTC.
720,000. That is rapidly approaching nation-state levels of reserves.
It is. It is shock-proof conviction.
Yeah.
But honestly, the most interesting part for me isn't the buying itself, it's the funding mechanism. How do they pay for it?
I assume they didn't just use cash from software operations.
No. They funded this by selling STRC perpetual preferred stock.
Okay, translate that for those of us who aren't financial engineers.
Essentially, they are issuing a specialized type of stock, equity in their own company, and using the proceeds directly to buy Bitcoin. Investors are buying this preferred stock because they want the yield it pays, and Strategy Inc. is taking that fiat cash and converting it into digital property.
So they are securitizing Bitcoin. They are turning their corporate treasury into a vehicle that sucks up Bitcoin from the market, funded by traditional institutional investors who maybe can't hold Bitcoin directly.
Exactly. It proves that despite the war, despite the inflation fears from the oil shock, there is still a massive appetite in the traditional capital markets to fund this trade. The institutional suits want exposure, and they are using Saylor to get it.
And speaking of the suits, let's talk about the banks and regulators. Usually this is the dry part of the briefing, but there's some movement here today that might explain why the market is so incredibly optimistic long term.
There is actually some surprisingly positive news from the traditional finance sector today. JP Morgan released a note regarding the Digital Asset Market Clarity Act.
We have heard about so many different acts over the last few years that never go anywhere. Why does JP Morgan think this specific one matters?
Because they believe this is the definitive catalyst for a massive recovery in the second half of 2026. The core of the bill is that it finally firmly separates the jurisdictions of the SEC and the CFTC.
So it ends the eternal turf war of, is it a security or is it a commodity?
Exactly. And the reason this matters isn't just bureaucratic housekeeping, it's about permission. Pension funds, insurance companies, massive sovereign wealth funds, they simply cannot deploy capital into a regulatory gray zone. It violates their mandates. They need black and white rules.
So JP Morgan is basically signaling once this passes, the big money is legally allowed to play.
Right. It unlocks the ability for them to move from these tiny experimental allocations into formal multi-billion-dollar strategic positions.
And it seems like Europe is trying to get ahead of this infrastructure build-out, too. I saw a note in the sources about Project Cabalis.
Yes. This is a major banking consortium over there. It includes ING, UniCredit, and BBVA, huge European players. And they accelerated their plans on March 2.
What exactly are they building?
A MiCA-compliant euro-pegged stablecoin. And they are already actively negotiating with exchanges like Bit2Me to get it listed and integrated.
Why build their own, though? Why not just use USDC or Tether like everyone else in the ecosystem?
It's all about financial sovereignty. Right now, the crypto market is heavily dollarized. If you are a massive European bank, you do not want your future digital settlement layer to be entirely dependent on the U.S. banking system and U.S. dollar equivalents. They want to integrate digital settlement directly into their own native infrastructure.
So traditional finance isn't fighting crypto anymore. They've realized if we don't build these rails, we are going to be left behind.
Exactly. They are moving rapidly from the fight phase to the co-op phase. They want to own and run the network layer.
Before we wrap up, let's do a quick check-in on the other corners of the ecosystem, social media and DeFi. What is the pulse there today?
A significant update from X, formerly Twitter. As of today, March 2, they have officially lifted the ban on cryptocurrency and gambling ads.
Wow, the floodgates are opening on retail visibility?
They removed them from the prohibited industries list entirely. Now, you might find ads annoying, but for the market structure, this is huge. We have noticed in the data that retail participation has been very low compared to the institutional buying lately.
Yeah.
This policy change allows projects to push content directly to millions of retail users again.
It brings the retail hype machine back online, right as the market is heating up fundamentally. And what about DeFi? I saw a governance proposal pass for above.
Yes, the OV will win proposal.
I love the absolute confidence in the naming conventions there.
It's definitely on brand. It passed with 52.6% backing. On the surface, it's a structural overhaul of their governance tokenomics. But the subtext is what really matters here. They are structurally preparing the protocol for institutional integration.
Institutional integration seems to be the underlying theme of the entire day.
It really is. There are strong rumors circulating about a possible spot exchange-traded product for Avi in the future. So they are essentially cleaning up the house so they can invite the institutional guests in.
All right, let's bring this all back to the start. We have a world that feels incredibly unstable right now. We've got kinetic escalations in the Middle East, drone strikes on major oil refineries, looming inflation risks. But we have a Bitcoin price that is up nearly 5% today. We have spot reserves at 2018 lows. We have regular citizens in Pakistan buying for safety. And we have Michael Saylor buying for corporate dominance.
It is a market completely defined by contradictions right now.
So for you listening and trying to make sense of this massive rally, what is the ultimate takeaway?
I think we are witnessing a real-time split in Bitcoin's core identity. And this is crucial to understand if you are allocating capital. To the Western algorithm, the trading bot programmed by Wall Street, Bitcoin is still a risk asset. It is something you automatically sell when the missiles fly because you need to raise cash.
But that legacy narrative is clearly failing today.
It's being challenged by the on-chain reality. To the citizen in Karachi facing capital controls, or the long-term strategic holder like Saylor, Bitcoin isn't a risk asset. It is the only safety available.
So the price action we are seeing is really just a tug of war between those two distinct worldviews.
Exactly. And as you watch that green candle climb 5% today, you really need to ask yourself this. Which identity is actually driving the price right now? Is it the genuine fear of the legacy system breaking that is driving people into Bitcoin as a lifeboat? Or is it simply the greed of traditional institutions stepping in to aggressively buy the dip before the fixed supply completely runs out?
Are we buying insurance against sovereign default, or are we just buying a highly leveraged lottery ticket? Or maybe, for the very first time, they are finally the exact same thing.
That is the fascinating question we are going to have to watch unfold.
We will leave you with that thought to mull over. Thanks for diving into the intelligence with us today. Keep your eyes on the news, watch the charts, and we will see you at the next deep dive.